What's up everyone? Welcome back to another video. And today's video is sponsored by... Actually, no one really sponsors my videos. Well, today's video was prompted by another fellow investor that had sort of woken me up to the fact that EQR may actually be a buy. And that kind of reminded me that the last time I really looked at this was in November, and I'll link that video down below. But I haven't really taken a look at it since, so I thought maybe now would be a really good time. So first things first, earnings are coming up. They report after the close on February 10th, so that's a Wednesday. And then since November, we've probably have gotten more clarity on two things. The first thing we know is that Q4 was just an awful leasing quarter in terms of collections, concessions, and occupancy. As far as I know, it was just horrifically bad. The second thing is cap rates have, for the most part, pretty much held steady throughout the year. Maybe in some cities they're marginally higher, but for the most part, they didn't increase due to risk, and they also didn't decrease due to interest rates falling. So they have pretty much held steady. So in the first half of the video, we'll look at some rent data in the 9 major markets that EQR operate in. And in the second half of this video, we'll then dive into the valuation part. And so these reports are conducted by Zumper, and they are from January of 2020 all the way through to the February 2021 reports. So here's the first market, it's Los Angeles. And all the charts are going to follow the same format. The solid line is the 1-bedroom metrics, and then the dashed lines are the 2-bedroom metrics, and then the black lines are EQR's new lease rates when they published their earnings report. And so I'll go through these pretty fast, and you can just pause them if you need more time. So here's Orange County. Here's San Diego. And San Francisco. It's Washington, D.C. Here's New York. Seattle. Boston. And finally, Denver. And Denver's chart has continued to look weird, even since November. And I don't know if that's just because of the way Zumper conducts their reports, because I don't see this disparity in Apartment List, which is another data gathering company. And so my takeaway from all of these reports is that rents continue to decline in Q4, but it looks like the bottoming out process is actually starting to occur. And I've also cross-referenced these rent datas with Apartment List. And I can also confirm on their reports that it looks like the rent bottoming process is also there too. And I'll show you a summary table of the two sources right now. So the question is, do I think the stock is a buy right now at $61.70 or something like that? And I think a good way to rationalize this valuation is to kind of just work backwards. So we know their share price and share count, and that can get us our market cap, or you can just look it up. We also know their debt that's on their balance sheet. And so asset values have to be around $31 billion for this investment to make sense. We know the annualized Q3 NOI, and we'll get to Q4 in a second, but let's start with Q3. So here's the NOI by region, subcategorized by urban versus suburban. And if we apply market cap rates that we can find on surveys, which have not moved much in 2020, then we can get the value for each submarket. And that means the portfolio value of the assets are around $35.5 billion in Q3. I'm estimating that their Q4 NOI would fall between 8 to 10% compared to their Q3 numbers. And you also have to subtract the NOI that's associated with the sold San Diego property. And so if you take this annualized Q4 number and you allocate that across their NOI percentages by region, and then you apply the cap rates, what you have then is your total portfolio value of around $31.9 billion. And if you subtract the debt amount and then divide by the share count, it comes out to around $65 per share. And you have to remember that the full year NOI that they're about to report will always look better than this because they still have some pre-pandemic results that are baked in there. So any good news or bad news will always take a few quarters before they trickle through to the financial reports. Next quarter, the good results from Q1 2020 is going to drop off. And the NOI will likely get worse as Q3 and Q4 data get replicated in Q1 and Q2. But knowing that the rents have bottomed probably means that today's price is traded rather fairly. It just means that there's no upside that's baked in, and there's probably no downside that's baked in too. So I would say at today's price, if you actually want to get in and get your feet wet, now is probably a good time. If you think that rents have bottomed, the pandemic probably won't get worse, and if that's the case, your risk reward actually probably looks pretty good. And I know this was a pretty quick and rough estimate, but I hope that it can still serve as a guideline in terms of where valuations are at. So with that, I bid you all good luck in the markets, and thank you, and I will see you next time.